Hi, this is Chris Reddick with Chris Reddick Financial Planning. In this blog post, I talk about keeping investing simple, especially in your 401k plan. So how do you keep it simple? I think one of the problems with modern investing is that you hear a lot of people talking about what is the next best stock and so forth. So, people tend to follow the herd in terms of investing, right? So they hear about someone else getting some great stock or mutual fund or ETF, and they kind of follow it. But the true way to invest is to really try to take the emotion out of investing, and that's very hard. Like us being humans, emotions run high, right? When the stock market goes down, we really feel that. We actually feel that more in our mind than when the stock market goes up. Okay, and then you might make these rash decisions and then sell everything, and they may regret it later, right? So there's really two approaches to kind of look at investing. One is, just kind of, if you have money, you just invest it right away. You put the money in when you have it. So say you get some inheritance or whatever, some large amount of money or small, whatever. So you just put it in when you get the money, and then you may say, well, the market might go down after I put it in, so how do I predict this type of thing? And then the other approach is what's called dollar cost averaging, where you just kind of keep putting in money every month, and you kind of see that with a 401k plan, right, where you're actually putting in money every month or every paycheck, and then it's dollar cost averaging. So the idea behind dollar cost averaging is that you're buying stock or ETFs at a lower price, so you're getting more value from it. So there's kind of two approaches: lump sum and dollar cost averaging. So the research in this study from Morningstar really kind of shows like some of the impacts on performance. So what you see in the investment prospectus, and then what you actually get. And part of the difference is some of the behavioral things that you actually do when you invest. Like, for example, you may buy higher cost mutual funds that would give drag on your portfolio, and then so the returns wouldn't be as good. So say you had a 1% expense ratio, so what it would cost for the fund compared to a low cost ETF. So that's one of the issues. So automating investing is also an important thing. So you could do like target funds in your 401k, like I'm going to retire at 2050. So you can have a target fund that mirrors that. Kind of overexposure to highly focused areas. So you might say, I want to just focus on this certain area. So you might get some sector type of ETF, and then you may be overexposed to that area. So it may be hot at this time, but then it may go down in the future. Okay, so putting your investments on autopilot and dollar cost averaging. So essentially, these are some of the things that the Morningstar report talks about, how that can really have a drag on your returns that you get. So something to think about. Basically, the bottom line is try to make your investments simple as possible, be diversified, low cost, all those types of things, and should help you in your investing approach. And try to take emotions out of it as much as possible, but that's always very, very difficult, right? As I mentioned, you remember past bear markets and then experiencing it in the future. Okay, so if you want to talk about investing in your 401k and different approaches, reach out to me on the contact page below. Take care. Bye.